Hello everyone, my name is James Ford and this is The Pragmatic Investor. My guest today is Michael Wiggins, a regular on the show, and I thought I'd have him on today to talk a little bit about the tech earnings. So, we began today by discussing some of the tech earnings we've seen so far, general thoughts, and also diving a little bit more into the Google earnings and also the SoFi earnings. Now, moving on from there, we also talked a little bit about the outlook for inflation and how this is affecting commodities like oil, which of course has been on a great rally, and of course natural gas, which is both Michael and I's one of our favorite commodities and investments. So we discussed a couple of different companies there and investment opportunities. Now, before we jump into the episode, I just wanted to remind you guys that if you're listening to this on Spotify, you can go ahead and subscribe to the podcast and get access to my exclusive weekly videos, okay? It's $8.99 and basically every week you will receive my weekend report. You may have already seen a few that I did over the last month. So, if you enjoyed them and you would like to support me, go ahead and subscribe. And with that said, I hope you enjoyed this conversation as much as I did. All right, welcome once again to the show, Michael Wiggins. Um, Thank you once again for coming on.
Thank you so much for having me. It's a real pleasure to come back. I'm very excited. We're in the middle of earnings season right now. So I'm predominantly a small cap kind of guy. So for me, it's really kind of just getting started. And I know that for a lot of larger hedge funds and the family offices, they predominantly invest in the mega caps. So for them, it's kind of, they already got a lot of granularity. But for me as a small cap kind of guy, I'm very much more interested in the small caps. That being said, I very much believe in the need for diversification. So I'm also kind of invested in Google that we're going to later on talk about. Um, I'm also investing in some other fairly large company like Palo Alto Networks.
Mm-hmm.
So I very much believe in the need for diversification, and I'll just kind of explain in like 2 seconds what my general idea of investing is. So
Mm-hmm.
as deep value return members know, I'm very much a diversified portfolio kind of person. That does not mean that I have a lot of stocks. I only have 16 stocks in my portfolio, but I have different concepts, different ideas, because ultimately investing is not so much about figuring out something better than anyone else. It's really by having staying power. And by having a diversified portfolio of ideas, you're able to withstand the vicissitudes in the market. So when things are not going your way, for example, later on in the conversation, we'll hopefully talk about energy. When things are not really going your way, by having different ideas in the portfolio, you're able to stay invested in the market. Because as we've seen since the start of, let's say, really the back end of May into August right now, there's been a re-rating in stocks, predominantly really long duration assets. Typically, these involve tech companies,
Mm-hmm.
but no one would have known that, right? So you can't really predict when there's going to be mass flows one way or another. But by having a portfolio with different ideas, some energy, some dividends, some tech stocks, you're able to stay invested in the market.
Mm-hmm.
So that's really what I'm kind of thinking about.
Absolutely. Yeah, that makes a lot of sense. Now, we did kick off earnings season a couple of weeks ago or last week.
Mm-hmm.
We began with Tesla earnings. I know that, market went down. Investors
Mm-hmm.
quite disappointed with that. I thought that was going to kind of set the tone a little bit for the rest of the tech stocks, really kind of
Mm-hmm.
thinking that maybe, as Nasdaq's approaching all-time highs, the AI narrative is kind of exhausting, but that's not exactly what we've seen, right? I mean, at the very least, we've seen a bit of a mixed bag. A good example of this is Google, which actually kind of beat expectations and really kind of finally after mentioning AI 100 times in
Mm-hmm.
their last two earnings calls, kind of finally got that little bit of an AI bit. And I mean, Google's a company that I love, so I've always been behind it. So, but tell us a little bit about what you thought about the Google earnings. What exactly were you looking for? What do you think investors liked about the recent earnings?
So for me, I'm a new investor to Google, and it's a company, obviously, like everyone else. I follow this very intently for many, many, many years, and it's not the first time that I've invested in Google. But what made a difference this time around is I follow a lot of tech companies, and it hasn't passed anyone's mind that the whole AI movement is what is leading towards, let's call it, how you discover something quicker. Okay, so for example, the way the search operates, you kind of go and you kind of go on a navigation, on a discovery. Discoverability is a term. You kind of go and you search like, what kind of holiday shall I have, and you kind of read some blogs and you spend a lot of time, and the longer you spend
Mhm.
on that discoverability, on that trend towards finding out your answer, the more ads you can see, and the more content that you're going to be seeing, the more engaged that you are. So
Mhm.
that is the business model of search. And what AI is trying to get you is to find you the answer as quick as possible. Okay, so um, if you get the answer, okay, you should go, because let's pretend I'm providing an example. It's not really true, but let's say, okay, Michael, you're the kind of person that likes warm weather. You want to go to Turkey next week, catch a flight, and everything is organized for you because
Mhm.
they know the type of person that I am. And that you don't need a lot of search. You kind of just go to the answer. So that's the findability. And what Alphabet is trying to explain to investors, and it's not only about name dropping. I think that the market is able, I believe that the market is actually more intelligent and more measured than a lot of investors think. So I'm a
Mhm.
value guy, and the definition of value guy is often that the market is wrong and I'm trying to figure out why the market is right. But I'm actually of the opposite opinion. I actually believe more often than not, the market is right. Okay.
Mhm.
That more often than not is, as Buffett calls it, the difference between night and day. Okay. So it can be nearly right, but not quite right. So that's where, our work comes in.
Mhm.
Now, what the market saw here is the idea, and I'll come to the financials in a minute, but it's the idea that it can coexist, the search and the the AI aspect of it, the findability. So the market has been seen that, okay, it's one thing to put out a narrative. Everyone can put out a narrative. These are mega cap companies, highly followed. It's not
Mhm.
just about putting like a little jazzy narrative and everyone's going to kind of uh, wish it away. They really need to put out the numbers, and the results from the ad is about 80% of what Google makes. The advertising business was very, very strong, and people were
Mhm.
like, oh, whoa, hold up, like, maybe it's the case that advertising is making a comeback, and maybe this whole idea that we were going to go into recession might not be happening, because remember, advertising is a leading indicator of what
Mhm.
businesses are trying to do. So if you're a business and you want to get a customer in through the door, you need to spend in advertising. Okay, so that is the first part of the business, is to try and get the customer in. So it's a leading indicator, and that leading um, spend goes towards Alphabet's revenues. So market is saying, okay, hold up. It could be possible that we may have been overreacting, that advertising is actually stronger than we previously felt, and it may be possible that we don't need to know the answer whether AI and search are mutually exclusive. So it could be something that they can coexist. So in that environment, everyone's thinking to themselves, okay, this is a mega cap company. It's
Mhm.
a leader in advertising. It looks to be growing. They're buying back a lot of shares, which
Mhm.
bolsters up the number of earnings per share. But it could be growing over the next 12 months at a 15% compounded annual growth rate. And if that is the case, paying approximately 23, 24 times forward earnings isn't such a bad bet. After all,
Mhm.
it's not the kind of stock that's going to implode on you overnight. So you're paying a premium
Mhm.
for the fact that you have some visibility there. You're paying a premium for a very well managed company, nicely diversified. And on top of all this, you have a business that has some potential to reinvest that cash on its balance sheet to do something. Now, here's the thing, right? I'll just be
Mhm.
upfront and honest. Historically, Alphabet has been very poor at finding out new areas to invest in. Okay,
Mhm.
I get that. That's the fact of the matter. But then I would say, listen, there's a bit of truth to that. But what is the expression that I read this in a book recently that a half truth goes all around the world before the actual truth is getting the boots on. So
Hmm.
it's basically not completely accurate, because you look at something like, say, Google Maps, that
Right.
is something that they were able to do. So
Mm-hmm.
maybe it's not 100% true. They obviously acquired YouTube. So, it's not 100% like people are saying, oh, they,
Mm-hmm.
they, they invested a lot in their phones and their phones didn't really work. Yeah, Amazon has also done a lot of investments into the phone industry. And no, it's just a very difficult nut to crack. So, yes, historically, they've not been able to reinvest into something, but that does not necessarily mean that they won't be able to do going forward. And I'll just add one final example. Google was one of the last ones to come into this whole cloud um, data storage uh, and sector. They were one of the
Mm-hmm.
last ones. So Amazon came in, like, I don't know if it's 2007, that ballpark, and then like 3 or 4 years later, Microsoft woke up, and then IBM, and then Google was like, oh, okay, let's do that. And they've gone from basically being like the last kid on the block to really kind of growing really, really fast. In fact, this quarter right now, Q2 2023, Alphabet's Google Cloud Platform was up 28% year over year,
Mm-hmm.
which is faster than Azure, which is up 26% year over year. We don't have the numbers right now for AWS. That reports tomorrow night, but I'm very much inclined to believe that AWS wouldn't go much above 26% year over year in growth. So,
Mm-hmm.
for all intents and purposes, the people that were the last on the block are actually taking market share from these giants. So, yes, they have historically not been able to reinvest that capital, but I just provided an example of Google Cloud that they were the last ones in, and they like do taking market share. And I don't know, it's very much down to the user, but many users tend to like actually spending time on YouTube. Another example is Google Maps. So there's a bit more nuance to say that that Google cannot really invent new revenue streams. So I just think that it's an optionality. That balance sheet's an optionality, but
Mm-hmm.
you're not really having to pay for that. That's just like, you may get it, you may not get it. Maybe something with self-driving car surfaces, maybe something surfaces there, but you're not paying for that, right? That's not even the part of the question. So there are different ways to play this, and typically when I invest, I like to look for two catalysts. So one catalyst would be that the underlying business's prospects are growing and you're not paying a lot for it. I'm a value investor by definition, but I'm also looking, if possible, it's not always possible, but I'm also looking, if possible, to look for a second catalyst to ignite the story in one way and to lead to a re-rating. Because as an investor, the thing that you're really looking for is a change in perception, right? So you go from a business that is, let's say, people have a lot of question marks at Google. People have question marks. Oh, can they coexist? This and that. So there's a bit of uncertainty. And once that uncertainty gets partially lifted, I'm not saying that it gets fully lifted, but it gets partially lifted over the next 12 months, there can be a reasonable amount of re-rating. One example that I can provide, that a recent example that I can provide that shows this, you rewind the clock 12 months to Meta's results. I know I'm looking in hindsight, and in hindsight, you everything you can say, whatever story you want to say. But it's this is a very well told story that 12 months ago, everyone was worried about the metaverse. They were spending a lot of the money on the metaverse, and that they're a mature business that they could not ignite, and they were not being focused enough, disciplined enough, and Mark Zuckerberg came out, yeah, okay, we're gonna have, it's been well talked about the year of efficiency. Yeah, they were like, yeah, year of efficiency, yap, yap, yap. But when the second quarter comes out and the third quarter comes out, and you actually see that transpire in the fundamentals, people are like, oh, you know what? Okay, I'm going to give this the benefit of the doubt, and that is the re-rating that I was talking about. That change in perception. That's really where I think the upside will come in Google over the next 12 months.
Mm-hmm. Yeah, absolutely. You make some very interesting points there. Of course, that recovery in ad spending that we did see, like you say, possibly an indicator that maybe the recession isn't coming. Of course, we could have a whole other conversation about this. I would say the jury is still out. I mean, as I like to be a bit contrarian, and just when everyone's thinking that nothing bad's going to happen, that's that's when things hit, right? But it's definitely going to be
Yeah, yeah,
interesting.
for sure.
We have a lot of kind of, you could say at the very least conflicting data, a lot of strong data coming in, GDP last week, for
Mhm,
example. So
mhm,
anyway, it's gonna be interesting for sure. And I also think I agree with your point that historically Google hasn't been that good at investing their money. I mean, if you look at, for example, some of the stuff they've done, but more recently, I think they've really got some good things going on. And don't quote me on this, but I was reading somewhere that the Google Pixel actually has been doing quite well in Spain, I think,
mhm,
which is where I'm
mhm,
from. But don't quote me on this. I know that my
mhm,
mother got it and she likes it anyway. Um,
mhm,
but yeah, it's interesting. And I think I also read an article recently about their TPUs, which are basically their AI accelerators. I think that's also a very interesting area where Google's growing and potentially could compete with Nvidia. But yeah, absolutely. For me, I mean, Google also in terms of the fangs, I think, like you say, it's probably one of the best valued, and they're always putting that cash back into share buybacks, which is always good, like you say. You're a value guy, so how do you think about the valuation Google? You were saying, that it's okay to pay 23 times earnings. Do you have like
mhm.
a
Yeah.
price target for Google?
So just before we kind of discuss it, so I will discuss about the price target just momentarily. I think the biggest problem that investors have is that they have inclination towards overcomplicating what is relatively simple. If you
Mm-hmm.
say this is the pitch, there's the Bill Ackman joke story that the shorter the pitch that he gets on his desk, the more compelling it is, and vice
Mm,
versa.
right.
So um, if it's a very simple pitch, I give often the example of when Warren Buffett talks about the Coca-Cola pitch. His Coca-Cola pitch is just the volume of Coke being shipped out each year compared to the number of shares outstanding decreasing. As long as the volume is going up and the shares outstanding is going down, that's it. It's not more
Mm,
complicated, and it has worked out tremendously well, right? So we have an inclination as investors to kind of look for something jazzy, and I understand that because typically we're all very competitive and we all want to try and get an edge on someone else. But sometimes just what's relatively simple and straightforward also works. The other thing that I would say, I don't particularly put a price target in terms of when I invest. What I do is I say I'm not going to exit this position for a year. So for 12 months, come hell or high water, I will stay in this in the course. And the reason why I do that is that I say to people that you only know a business once you've become the business owner. Okay, so the example that I provide is a person may be the biggest fan of Apple. You might have all the gadgets and you may be really into Apple, but only when you bought a share of Apple do you really think as a business owner, and you start thinking about, okay, I wonder how much the services are going to make over the next quarter. I wonder how much they're going to make from apps. And you start thinking a little bit more like that. And investing in Google for me is like that. You can follow the company for as long as you want, but until you're the owner of a share of Google or whatever, you only then can you really start thinking as the owner of the business. And you have a thesis, you have an idea of what the stock could do over the next year. But in the short period of time, let's say 3, 6 months, a lot can happen in terms of news flow. And you can think, okay, I bought it at, let's say, X price, and then 2 months later, it's 10% cheaper. And you're like, oh, I didn't think about this, or I didn't really think about that because I wasn't an owner of the business. So I make this claim that I will not sell the business for 12 months. After 12 months, I become the owner of that business. I've understood much more about the business because I'm in the driving seat, and then I can reassess. I could always say, okay, I think that the stock is going to go up, let's say X amount, but that's just, like reading through tea leaves. It doesn't really have anything to it.
mm-hmm. Yeah, that makes a lot of sense, and I can definitely identify with your sentiment of, oftentimes making things a little bit more complicated than they should be when, like you say, just look at the business and own it, no? A bit more of the Warren Buffett style. So moving on from Google earnings, I also wanted to talk about a stock that, really, let's say, surprised investors, or at the very least, Gave us a very big jump in stock price, which is SoFi, of course, a business that I think is getting talked about a lot. So we saw SoFi jump about 20% on earnings, and you did write an article about the company. So I was just hoping you could share your thoughts on it.
So I've been very bearish on SoFi for a while now. I can't remember how long. And, I'll be honest that admittedly, this quarter, I feel like it's kind of more of an interesting story than it has been for a really long time.
Mm-hmm.
And, there's a lot of kind of like everyone say, oh, the student debt program is coming up, and like that's already in the share price. Everyone's like, oh, starting 2024, it's going to be different. Like it's going to be a new day, and it's like, no, everyone knows that's already in the share price. Everyone
Mm-hmm.
thinks about it. Everyone's discussing it. That means it's in the share price already.
Mm-hmm.
So that being said, I see that the business has the capacity to be reasonably profitable. I won't say very profitable, but has the capacity to be reasonably profitable. And I didn't think that beforehand.
Mm-hmm.
I will
Right.
also caveat that it appears to me that the member growth is slowing down. This is I also had a look at your article, and this quarter right now, Q2, the
Mm-hmm.
number of members was up 44% year over year. And that is a deceleration. It's been a consistent deceleration over time. Now, there's a big question mark. Why is it's a relatively new business. Why is there a deceleration in the adoption of customers? I'm very much focused on the customer adoption curve. I often say this to investors. If you're looking at a business, it's more important to look at the customer adoption curve rather than the revenue growth rate. The revenue growth rate can be up, can be down, things can happen. You can spike it one way,
Mm-hmm.
there are things that can happen. But the customer adoption curve is really, really important. And this is decelerating. Now, my first question is, why is this decelerating? Could it be the case that with interest rates going up, the appeal of using SoFi versus some of its competitors is not that big? Remember that they are offering to depositors approximately 4%, and they were like one of the only ones offering 4%. It could be now that some of the other banks are also, because interest rates have come up, there could be some other banks are also offering something approximating that. So there's less of a divergence between SoFi and their competitors. That could be one reason. So I don't know, but that's one reason. The other thing that I think about is, if hypothetically the customer adoption curve is starting to slow down, and management is relatively aware of this, as I'm sure they are, they may find that, okay, we don't need to be as aggressively reinvesting into the business. Maybe we can kind of take our foot off the pedal a little bit and show some more profitability. This will be a good point in time to kind of show that we can be quite profitable, get people kind of excited about us again. So that's why I said, yes, the stock was up, but I don't read that much into that. It's always a good indication when the stock is up. Obviously, stock is up versus down. That being said, it happened to be on a day that high risk stocks were very, very aggressive on that day anyway.
Mm-hmm.
So that kind of modeled the picture. And on the next day, the share price came back down. So right away, I'm saying to myself, it's
Mm.
I wouldn't read too much into that fact. There could be something there. But I'm also of the opinion that, okay, maybe things are not as bad as I said in the past. That being said, when I've been bearish, the stock has been basically stuck at around about $9, $8 for about a year. So like it was a fair bearish call at the time not to invest in this business, and I think that came out to fruition. But there's no problem in reevaluating a hypothesis with the passage of time. When the facts change, I change my mind, right? So here I'm starting to say, okay, there's a bit more to this story, and it could be interesting, but I'm just not as bearish. Basically, I'm kind of like on the fence right now, and I think that it really depends very much about how the next couple of weeks and months in terms of inflation starts to percolate. Because hypothetically, this hypothetical scenario, let's pretend, I
Hmm.
don't know, let's pretend that oil prices start to come back up a little bit, natural gas can start to come back up a bit. All of a sudden, what was looking like inflation coming down, it actually ends up being a bit more sticky. And this could change the dynamics quite a bit, because ultimately the whole bull case for SoFi is that as interest rates get cut in 2024, that could allow the multiple to expand slightly. But if
Hmm.
interest rates remain higher for longer, then all of a sudden you're kind of, okay, inflation is still an issue. The Fed can't really have the tools to kind of cut the interest rate. And then this kind of muddles the picture somewhat. So that's why I'm kind of like on the
Hmm.
fence. It's not like, it's a bit kind of 50-50 can go from here.
Yeah, absolutely. You make some good points, and I think there's a bit of truth to both things you said. On the one hand, yes, that profitability picture improving, I think, kind of shifted investor sentiment a little bit, but also there's some element of something going on a little bit behind the scenes. I think some options calls or something, because like you said, the stock went up 20% on the day. It's now lost about 9% yesterday. I'm looking at it now; it's down 2.8%. So it's actually given up a lot of those gains, and I mean, well, why do these things happen? Personally, I like to use technical analysis, so this is kind of a pullback that I was looking for a little bit. But like you said, I think there's a little bit of both of those things. I mean, I like the long-term story for SoFi. I think that at the very least, you need some companies to innovate a little bit in the fintech space, and there's definitely some wiggle room there. So we'll see. But I wanted to get into what you were just talking about, that talk about inflation, because that is something that I've been talking a lot about, that idea that inflation could persist, and the big catalyst really is well, I'd say maybe kind of two kind of correlated, which is higher oil slash energy prices, and maybe also kind of correlated with a lower dollar. So yeah, let's talk a little bit about that, because we have seen oil really give us quite a strong rally in the last couple of weeks. So the energy sector obviously kind of coming back to life, inflation expectations, maybe coming back. What are your thoughts?
So I think it's quite ironic that this whole idea of the of Joe Biden's IRA bill, the Infrastructure Reduction Act,
Hmm.
is essentially to provide stimulus
Right.
towards this renewable
Hmm.
transition, renewable energy transition. Now, why do I say it's ironic? Is because at this moment in time, electricity in the US, about 20% comes from renewables. Okay, the game is to get that to, let's say, 60 or 70 maybe percent
Hmm.
coming from renewables. Just for your viewers, renewables typically mean wind turbines and solar panels. Okay, now it's at approximately 20% after plowing trillions of dollars into this. Okay, and estimates for this year, I think, around the world, not only the US, admittedly, but around the world, is for somewhere in the ballpark of $5 trillion being invested in renewables, to this whole the whole infrastructure to make the renewables happen. Okay, but
Hmm.
just sticking with the US for now. Okay, if you get 20% of your energy from renewables after they've been on this journey towards the energy transition for, let's say, 20 years, to get it to 20%, to go from 20 to 40%, that's a doubling, okay? And to double that, you need to be able to have double the infrastructure. So I said it was ironic, because to actually get much more of the energy coming from renewables, you need to actually invest in a lot of manufacturing and construction. So that's actually going to stimulate perhaps some uh, unforeseen aspects of the inflation. Now, just sticking with this whole energy idea. So 20% comes from renewables, okay? So that's not a big thing, but to get it to 40%, then it starts to become interesting. Why is it becoming interesting? Because renewables, by definition, as I said at the start, this is wind turbines and solar panels. By definition, these are variable loads, okay? So it might be windy, it might not be, it might be sunny, it might not be. So getting that energy, that variable energy, may cause some problems, because at this moment in time, it's like a very reliable base load. Okay, you
Hmm.
get that energy coming through. You may burn some natural gas, or not so much in the US coal, but you could burn some coal, nuclear power, so it's quite a stable and predictable energy. Now, if you add to the whole grid this variable input, it causes a lot of problems. Let's say, hypothetically, for the sake of discussion, that Google is running on some massive data center, some AI technology that's really, really power hungry. They
Mm-hmm.
need to know they're going to have access to that power, like, reliably, no questions asked. It just needs to come in very high intensity. And for the grid, they're going to have this kind of variable load coming in too, which may or may not happen because the weather might be good or maybe bad or whatever. It causes a lot of problems. So you need to build out that grid. And just to complicate things even further, often is the case that that renewable energy is made, let's say, away from the city center. So you have a problem here that you need to transport that energy, let's say, for example, offshore wind to the capital or to,
Mm-hmm.
let's say, a large data center. So you need to build out all that grid to be able to incorporate or embrace that whole variable load of energy. So there's a lot of complications here to get that energy to go from 20% to of renewables to, let's say, 40 and beyond. So all this Infrastructure Reduction Act, it's supposed to kind of, reduce the inflation,
Mm-hmm.
but actually may cause a lot of problems. Because the irony was that it was when energy prices were really, really high, and everyone's like, okay, we need to bring energy down, and that will bring down inflation. But all this construction could actually end up rising quite substantially the amount of inflation. That being said, it's one thing for us here to be discussing the energy transition, but to actually get boots on the ground and the regulation and all the materials and to build that is going to take time. Okay, so it's one thing to say, okay, the energy transition is happening, blah blah blah, but to actually have it happen and be able to get the energy from renewables could take several years.
Mm-hmm.
So we could be talking about a lot about getting energy from renewables, and everyone wants to talk about the energy transition, but this could be out to the end of this decade. So the energy transition at its core is the displacement of thermal coal, which has a lot of carbon, with something that has less carbon.
Mm-hmm.
Natural gas has approximately 40 to 45% less carbon intensity than coal. So that's an obvious, what they call a bridge fuel, because it has a bit less carbon than coal. So it's the default go-to.
Mm-hmm.
But at the same time, the demand for natural gas continues to go higher because they got EVs. So
Mm-hmm.
if you have in your house to charge an EV, rather than going to, let's say, a pump and get oil into the car with the way to do it would be to charge the EV for your house. You need more charge to come
Mm-hmm.
in, and you may or may not also in the next coming years have a heat pump in your house. So
Mm-hmm.
that's yet again another source of energy that's going to rely on natural gas. And then just to make things even more difficult, in Europe, the price of natural gas is approximately 5 times more expensive than in the US. So there's a need for LNG cargoes to be shipped out of the US towards Europe, because and Europe and Asia, because it's such a large discrepancy. Now, no one is really talking about this because last winter was very mild. This summer in the northern hemisphere, it's been really not as strong as many people foresaw. That being said, the southern parts of Europe are just blazing hot, but the northern parts of Europe haven't really been that strong as people had expected. So there was a very warm winter and a very cool summer, and so the demand for natural gas hasn't been that strong for people to run on air conditioners and heaters. But that doesn't mean that's the status quo. We can't really be relying on the weather for a medium to long term horizon. So you're going to have to build out more LNG cargoes, so LNG terminals. So starting 2024, the back end of 2024, there's going to be a lot more terminals being built that are going to be able to export volumes of natural gas
Mm-hmm.
away from the US to the rest of the world. So there's a lot of different ways that I believe people are not really thinking about the demand for natural gas over the next 12 months. Now, just finally, what's really interesting about this whole idea is that a lot of these operators, they're particularly in the US, a lot of these operators in the Permian Basin, they have the cost of production of their natural gas is approximately $2 to $2.50. Antero Resources that I own is at $2.50. Now, they are trying to bring that down slightly to around $2.40. So the way it works is that you get a lot of operating leverage in the business, because once natural gas goes beyond, let's say, $2.80, $3, $3.50, all that pricing power just drops to the bottom in terms of free cash flow for the business. So certain businesses in the Permian Basin have very, very strong balance sheets. Antero, I believe, has one of the best balance sheets. And because they have such a strong balance sheet, once the price of natural gas gets to around $3.50, you get a lot more free cash flow. And that free cash flow, rather than being going to the balance sheet, is able to be returned to shareholders. So a lot of them are kind of similarly priced at approximately 5 to 6 times forward free cash flow. But if you actually look at their balance sheets, there are quite a lot of differences. So I think that is very, very compelling aspect to invest right now in natural gas. And I think as well that you cannot really displace the amount of energy that you get from oil, particularly when it comes to, let's say, shipping or the airplane industry. But aside from those two immovable sectors, I think that beyond that, when you look at towards industrials, when you're looking towards residentials, there's going to be a lot more demand for natural gas in the next 12 months to 2 years than people are really thinking about right now.
Yeah, absolutely. As you know, I love that you're a natural gas bull. I'm also a natural gas bull. It's very interesting because you brought up something that I actually meant to ask you, and that is the idea of that divergence between prices in the US and Europe, right? And I actually go ahead and disclose right now that, the other day, a couple of weeks ago, I bought some UNG. So that's the United States natural gas. And the thesis behind that being that eventually, right, we're going to have to see those prices converged, right? Is that something that you believe? What kind of timeline would you see for that? Would be one question I have for you, and then we kind of already answered that. But then the other question would be: you talk about those transportation system that's coming online. Would you say that that's a good way of investing in natural gas as well? Are there some opportunities there in terms of investing in these types of companies?
So, from my memory, the UNG is forward derivative.
Mm-hmm.
So it's a bit more complicated. That has like an extra layer of complexity.
Mm-hmm.
So that you can have the way I say it is like this: so you can have an idea in the market,
Mm-hmm.
and
Right.
you need that idea to be able to be expressed in a way,
Mm-hmm.
and that expression, that period of time you hold the instrument, may not align with the market's inclination to see things your way. And
Mm-hmm.
so I personally haven't gone that route. I think that investing in the producers is a less frills based, but I think it's the way I'm trying to invest for the
Mm-hmm.
members of my deep value returns community is I'm not trying to go from zero to hero. I'm trying to provide stability to the portfolio. So there is a natural gonna be over the next 2-3 years an arbitrage where you get the natural gas from the US to Asia and Europe. There's going to
Mm-hmm.
be a bit of a conversion there. I don't think it's going to erode fully, but there's going to be a bit of a conversion there. But I believe that investing in the producers could be a better way. And there's not a right or wrong way. Just when it comes to investing, you need to do something that aligns with your temperament. So for me, I try to invest in businesses that have very strong balance sheets and that you can stay with that investment for at least 12 months, because in a short period of time, many things can happen.
Mm-hmm.
So the way that I always, particularly when it comes to commodities, just pick out the businesses that have the cleanest balance sheet, because you don't want any question marks of like say, oh, I need to send this capital back to pay for some debt or whatever. You don't want any of that complication, okay? Because you don't know, things can turn sour really, really quickly, and you don't want to have to be selling, at a distressed price. You just want to have things on your side as much as possible, because ultimately investing is a game of probabilities. So it's really important that you start with a good option there, like a good balance sheet, so that things can happen that are not what you thought at the start,
Hmm.
and you can stay with it. I also think that as more and more countries, particularly in, let's say, India and China, start to move away from coal, at some point, there's going to be more demand for natural gas. Now, the irony is, everyone thinks about China in terms of it being a heavy polluter, but actually they're much more in the front of this whole energy transition. And they have made significant investments in the past several months to get guaranteed LNG cargoes to go to them. Not
Hmm.
really from the US, as you might imagine, but from Equinor, that's in Europe, is Norway. So they're really, really aggressively investing to get hold of this whole natural gas, because they're buying into this idea that, yeah, we are very much about nuclear. We haven't discussed nuclear on this call today, but they're very much investing in nuclear. They're very much investing in the whole energy transmission in terms of solar panels. They're really doing everything right. But they're also saying, okay, yeah, but let's not just forget about natural gas. Let's go for all energy sources so that
Hmm.
we are not really being left behind in any kind of unforeseen scenario. So I very, very much believe that over the right now, the biggest energy source in the world tends to be oil, but I really believe that we're going to start to see natural gas take some market share away from oil. Now, the oil will still continue to have its uses, as I said, in freighting things around, heavy, bulky things. You can't really put, let's say, a boat with a lot of natural gas. It just wouldn't work. And you can't really store it with, let's say,
Hmm.
like batteries, like a battery operated boat, because 50% of the boat will be taken up with those lithium batteries. It just doesn't make any sense. What are you shipping then? You're just shipping the batteries from place A to point B. So
Right.
I really, really believe that you're going to see natural gas become like the default go-to primary source of energy. So I think that the outlook for natural gas is really, really good.
Hmm. Yeah, absolutely. I mean, obviously, I agree. Just back to my question, are there any companies, I mean, that you think that could be interesting in terms of, developing that network of transportation, so to transport the
So the
LNG?
one, yeah. So the one that I'm looking at, but but this not so in my portfolio. I have quite a few energy businesses,
Hmm.
and I don't want to have all my eggs in one basket. But
Right.
one interesting idea that I think is Schneider. The ticker is LNG, and I
Hmm.
think that this is a really, really good and well operated business. And the reason why I find it so interesting is because they are investing in what they call Corpus Christi free. I think that comes in around about 2025. So it's a large LNG terminal. But compared to, let's say, some of the other ones like Tellurian or Next Decade, they don't need to raise capital from outside shareholders. They're predominantly self-funding, and
Hmm.
this takes a lot of risk off. And a lot of investors kind of want to go towards something like a Tellurian that may or may not go like to the moon. But I think that investing is about really going for those bets that are more likely than not to work out, rather than going for something that there's a 50-50 chance that it can go to the moon. Really try to go for something that's kind of safer.
Hmm.
And I think investing in Schneider, I think that's a really good way to play it. I personally would not be recommending some of these smaller ones that still are in the process of getting FID, final investment decision. So yeah, I think that that would be my go-to investment if I was to recommend somebody. But I don't have a position in it, so yeah.
Absolutely. Well, you gotta invest in stuff that you're comfortable with. I like to think that, in my service, I offer the chance to get a little bit of both. I like to talk about it as, you're filling you have two buckets, right? One would have your, like you say, strong balance sheet, good cash flow kind of stocks, and then, you can play around with some money. I think, you can definitely go for those moonshots sometimes. Gotta live a little.
Yeah,
But
for sure.
but Michael, I can't thank you enough for coming on the show. Always great having you on, hearing your thoughts on tech, earnings, and always energy as well. And again, thanks for coming on. Really enjoyed it, and hope you'll come again.
Thank you so much, Ryan. Thank you. Bye bye.
All right, Michael. Bye bye. Bye everyone.